Hello everyone and welcome into the channel. My name is Brent and in 2025 it has been a roller coaster of a year, from the unexpected wins to the tough questions we've all thought about whether we should sell or whether we should stay invested. But through it all, I have continued to stay invested, and here's how that decision could change everything for you and me depending on whether you had sold or stayed invested. So with that said, in this video, we're going to be covering the market journey of 2025, why I chose to never exit the stock market, and let me know down in the comment section below, have you bought, sold, or completely cashed out of the market? I would love to hear from you guys. Also, if you guys enjoyed this video, drop a thumbs up button below, would really appreciate it, and subscribe. Okay, so we'll go ahead and do a quick recap of, myself. I'm 39 years right now, 39 years old, and I've been invested in the market for nearly 20 years. I started super young, at the age of 19, as I was getting invested into as I had joined the military. That's when I officially dip my toes in the stock market. But like most investors, I made mistakes and mistakes and mistakes, right? But the number one mistake that I have, the number one decision that I've never regretted since started investing, is to just never sell. It's staying invested in the market, not trying to time it. Some of the mistakes that I made super early on when I started was when I joined the military, we had the option of opening up a savings plan. I opened it up. I started depositing money in, and I watched that slowly progress over the few years. I wasn't making a whole lot as an E1 joining the military, so I didn't think much of it. But soon after a few years, I was thinking, why hasn't this portfolio grown, substantially, right? I went in 04, 08, there was a crash, sure, but it should have gone up after 08 into 010. So right around 2010, I started questioning my portfolio, wondering why it hasn't recovered or just kind of moved in the recovery fashion that I would have expected to have. And when talking to the department that kind of handles all that, they said, hey, you might have invested into your thrift savings plan, but you never changed your fund from the G fund, which was mostly, invested into bonds, into something that was the C fund, which tracked the S&P 500, or the S fund that tracks the Nasdaq. So that was one of the early on mistakes that I made, was making sure that, when you're putting capital into the market, make sure that you're actually investing it into performing assets, or assets that you want to be invested in. And the second one for sure was staying invested in the market. Once you made your investment, stay invested, don't sell, especially if you're investing in something that tracks like the market, the S&P 500, or the total stock market fund like VTI and VU are very popular funds that are recommended by tons and tons of investors. So, common questions I've received so far in 2025 by both friends, co-workers, past co-workers, and just investors in general that are interested over on Threads. Have had some interesting discussions on whether they should sell, should they exit now and try and time the market, at a better opportunity. My answer has always been pretty solid. I don't believe in fully exiting the market even during major corrections, because you don't know where the bottom's out. Trying to time it to sell out of a position and buying in at a better price is you're not going to be able to do it. Very unlikely that you'll be able to sell and buy it at might get a little smidge there, but there also could be that heavy bounce back, especially where there are days where the market would correct 2, 5, 10% in a week. Those bounce backs are going to be super heavy and quick, and that all of a sudden you missed out on a huge gain, right? There was one day here in February, April, where the market was up 5, almost 10, no, no, it was up 10% in a single day. So by selling out and trying to time the days, you could miss out potentially on huge, recovery days. That is just not safe. So, never exit never exit the market fully, even during downturns. So why I instead stay corrected is that the market is a long-term engine that compounds value. This is one of the callbacks to that first $100,000 is going to be really hard to hit, but once you hit that $100,000 mark, it's going to be compounding even faster, right? If you've been invested a few years, you have roughly $10,000. The market's going up 25%, 25% in a year. With $10,000 invested, you just made $2,500. That's a great return, right? 25% on your investment is a great return. But once you hit that $100,000 mark, that 25% return is now $25,000. That's a quarter of the way to that next mark of $200,000, right? It could take you several years. It could take you up to 10 years, depending on how much money you're invested to hit your first $100,000. But then you hit your first $100,000, and then next year you're up to $125,000 plus whatever you invested. Then you're up to $160,000, $175,000 in your third year, fourth year, right? Then the fifth year, you're up to $200,000, and it just begins to compound more and more after that. So dips are not panic signals, as much as everyone in the media and everyone here on YouTube likes to tell you. There's going to be tons of dips and tons of panic sells, and the whole media is telling you to sell. The market's going to zero, everything's crashing, but they're really just buying opportunities. If you go out and you're going to a store and something that you really love and like to buy frequently is on sale for 10, 20%, I'm trying to go buy some cool stocks that glow when I'm walking, right? I don't know why I picked that as an analogy there, but we're talking about the market right now. So S&P 500 was $100, and you were buying it, and hey, now it's $80 a share, and it's something that you're not, if you're going to be invested in for the long term, right? 10, 20, 30. I don't know how old many of you are out there, but the majority of viewers are between 10 to 40, right? So we still got between 20, 30 to 40 years of investment time frame. So these individual dips that are taking the market down 10, 20%, they're just really buying opportunities. We're able to buy back more shares with the same amount of capital, right? So use those opportunities. And that's why I like to focus on the long game and avoid emotional decisions. So my strategy has always remained the four big key ones. Dollar cost, the other one, right? There's five, right? Know what you're invested in. When you are invested in your investing journey, when you open up an account, make sure that you actually know what you're investing into. Start broad with ETFs that track either the S&P 500 or the total stock market. That's an easy, quick one. Continue to dollar cost average. Set up a plan, whether it's a weekly plan, bi-weekly plan, or monthly plan. Continue to dollar cost consistently, because that's going to be buying at highs, going to be buying at lows. You don't try and time it, you just buy. Track your net worth. That way you can see, it's kind of a nice, encouraging thing to see, ooh, I hit $10,000. Now I'm at $50,000. Now I'm at $100,000. Now I'm at $500,000. Now I'm at $1 million, right? Those are really easy, quick ways to kind of, quick wins. You could track really easy, and even set up a journal or something like that, right? Diversify between growth and dividend stocks. This is kind of depending on how you are. I'm still pretty early on in my journey, so I had at one point was pretty heavily invested into dividend stocks, but I did turn away and not specifically invest into dividend stocks. I still invest into dividend stocks, but I do go for more growth oriented dividend stocks if I do invest into dividend stocks. But I still target specifically growth, with the majority of my portfolio is focused on the S&P 500, whether it's in BOO or something very similar related. And then the last one is reinvest dividends to compound returns. So you get paid back 2.5%, 5% annually from dividends. For example, right, you get $100,000, you get 25 or 2.5 or 4%, you get $4,000 back per year, quarterly, or I don't know, timely. Reinvest that back in, and you're going to get buying back more shares, which is going to affect your next year's returns as well. So not only will your initial investment have market returns, but all the dividends that you reinvested back in will also receive market returns, pushing your portfolio even further along in total. Now, early 2025, it was a big test of patience and not to sell. The market did fall over 20%. $12 trillion was erased within 2 months. Now, the cause of this was tariffs being escalated and economic uncertainty. There's still a ton of uncertainty out there, but we did hit a bottoming out period right around April 11th, 2025. I have a next slide that I'll cover here in just a second that'll kind of showcase that date. But tariffs came out, they were higher than expected across dozens and dozens and dozens of countries, but now with the primary one being mostly China, and the rest of the countries had have a pause of 90 days as they come to an agreement, we can see that our portfolio had stopped falling and bleeding out and has had a little bit of a gain there, right? My portfolio is still down significantly from those February 2000 highs, but it'll all recover in time. When you look back a year from now, 2 years from now, everything will just look like a tiny little blip and we'll have moved forward. So back on 18 February to the 8th of April, the market fell substantially. Here we have the S&P 500 in green, the Dow Jones Industrial Average in blue, and the NASDAQ in orange. So the Dow Jones fell down a whopping 15.57% from highs to lows. The NASDAQ fell 18.81%, and the NASDAQ right there fell 22.86%, putting it into correction territory. So this is, as we said, in less than 2 months, the US market lost over $12 trillion of value, all tied to rising tariffs. You can see here, this is from 18 February up until April. So less than 2 months, just huge negative losses. But guess what happened soon after? The rebound took place. So this is a graph of April 8th. So here we had till April 8th, from the highs to the lows. It took us, 2 months. Now here is a graph of just 1 month. This is just a 1 month time frame now. 1 month now instead of 2 months. This is now 1 month from February 8th, April 8th up until May 6th. When I'm recording this video, it has been officially almost 1 month now. We can see the S&P 500 has put on a 12.52% gain. The Dow Jones has put on an 8.42% gain. And the NASDAQ has put on a whopping 15.65% gain. So if you had sold at any time during that downturn, right, you could still be down here if you had sold out, right? If you're looking at the market, it's continuing to bleed out, bleed out, bleed out. Here's that heavy waterfall drop, and you're like, okay, I got to get out of this market. I'll buy back in later, and you sold out. You could have potentially missed out. So I continue to dollar cost, I continue to invest, continue to reinvest dividends and dollar cost average. And those who exited captured losses and missed out on the rebound. So rebounds can be very heavy, as we have seen right here. Just within the last 4 weeks, this has gone up on 4% on average per week. This has gone up 3% on average per week. And this has gone up 2% on average per week. We can see here that we're really close to that 200-day moving average. So this is going to be a period within these next 2 weeks, whether the market will be able to break above those 200 days or retract a bit, but it's completely fine. That could be another buying opportunity, right? So final thoughts: stay consistent allowed my portfolio to slowly recover and grow. I was continuing to buy on the way down, buying back more shares as cheap as I could get. And then as it recovered, I'm actually better off now in my positions than where I will be when it fully recovers back up to where I was, right? Because on the way down, I was buying. So when it does recover beyond my buy points, back to that initial point, I'll actually be slightly higher than where I was in total value than if I had tried to buy here. The market was kind of moving a little bit higher here, and I was trying to buy those heavier chunks. I wouldn't have had that as much growth, versus over here I'll have much more growth just because of the compounding effect. So the market rewards patience and consistency. Don't let fear drive your decisions. Time in the market beats timing the market, as always. So that is going to be it for this video, guys. Let me know down in the comment section below, have you guys stayed invested in the market? Have you sold anything? Have you transferred or kind of converted your portfolio a bit? I would love to hear from you guys. Also, definitely go down below, give this video a big old thumbs up, would really appreciate it. And subscribe if you guys enjoyed this video and stayed till the very end. So that is it. Thank you all for tuning in. I will catch you guys in the next video. Bye-bye.